All right, it's the top of the hour. Good afternoon, everyone. My name is Cris Paulson, and if you don't know me yet, I'm a regional director or regional sales director here at Golden Care. Thank you all for joining us today for our presentation on Mutual of Omaha's long-term care product and software. We hope you enjoy it. If you have not visited our agent website, I would encourage you to do so by going to goldencareagent.com. As you can see under Why Golden Care on the right there of your screen, we offer lots of good resources and tools to really help agents be more successful. For example, our care options resource, which helps clients and agents alike by getting them a health and wellness hub and lots of information related to their care and lots of other good information too. But it also helps you agents as it can act as a lead and referral tool for you. For more information on care options and all of our agent resources, please visit us at goldencareagent.com. You can also call our marketing team at 1-800-842-7799. We are always happy to help. All right, today we're going to be going over Mutual of Omaha's long-term care product, Mutual Care Custom Solution, both the product as well as the software that we use to create illustrations. It's a very intuitive software. It has all the latest information on each state and any changes that are made to the product. Each state's a little bit different, and subtle differences and changes are made somewhat regularly or infrequently, and we always make sure that the software is up to date as a result, and I'll go over some of that information. We have a lot to cover today, so I'll do my best to stick to the 30 minutes, but I make no promises, and I'm officially apologizing ahead of time if I do go long. So feel free if you have to bail after 30 minutes. We will be recording this presentation, and we'll make sure and get you out a copy if you need that. I just want to make sure I don't skip any of this good information, as it's very important to know. All right, now I know we're all sick of hearing about COVID, and I am certainly no exception to that. But I would be remiss if I didn't mention how it has changed our industry. Here are some notable facts, including that you're 11 times more likely to die in a senior health facility being compared to being seen at home for your long-term care services. 61%, big number, 61% of people that were surveyed told us that they would rather die than go into a nursing home. These are powerful facts. Let's face it, seniors are concerned about their health and their safety, as well as being socially isolated from their loved ones. The bottom line is COVID continues to fuel the need for long-term care insurance now more than ever. So make sure you're telling your clients how you can help keep them out of the nursing home. All right, so I'm going to open up the software. I'm going to go over the features and how the software works for building quotes and sharing those with your clients. All right, so here we have the Mutual Care Custom Software or Custom Solution Software. Here at Golden Care, we helped, along with Mutual of Omaha, to build this product back in 2013. And we were pretty proud of that and our relationship, our carrier relationship with Mutual of Omaha. They're great. We value it very much, and they offer a great product, and I'm going to show you why here shortly. So let's get right to it. So on the left-hand side here, hopefully you can see this. We have a few different options. You have client, you have agent, you have quotes. Okay, this allows you to customize each illustration to your client's specifications. So you see the person in red here, that represents a male. The person in blue represents a female. So I just named them Mr. and Mrs. Valued Client. And then the illustrations will show their names as you type them in here. So that's why you do that. Also under agent, you have the ability to type your name there. I put myself down. You don't need to worry about the phone number, the license number in most states. And then under quotes here, you have the ability to run multiple quotes and compare them side by side, premium-wise, benefit-wise, to really hone in on what your clients are looking for and would need. All right, so also on the top here, you see some different options. New client, open client, save client. These give you the ability to essentially, you can, if you're already in a quote, you can start fresh by clicking new client. You can save individual quotes inside of this software, and then you can open client to review those later. I won't go into that, but it's pretty self-explanatory options that you have there. You also have some other options here too: print, preview, email, and PDF. I'll be honest with you, print and email are not two that I use very often, because preview will just basically, once you have the quote built, you can take a look at it through this preview option, and you can do the same thing with PDF, view the same information, but you can also save that to your desktop or in a folder for you to view later or share with your clients. I'll show you a little bit more about that at the end. And then the guide option is really nice because you have the ability to open up a product guide, also an underwriting guide, and search through quick to get answers for your clients. Should you be in front of them, let's say, or you're on a Zoom call, they have a question, you can quick pop open the product guide or the underwriting guide, hit Control F for a universal search, and search for, say, diabetes, or search for association discounts, or whatever the situation may be. You can search in each of these in PDF form. It's really nice and convenient. You don't always have to have it in front of you, but if you know where to go to get that information, you have what you need essentially. All right, so let's get into the meat and potatoes of this plan. In our opinion, Mutual Care Custom Solutions is the best long-term care product in the market in the United States. Some of the reasons for that are competitive-wise. From a premium standpoint, they're either in the running for the cheapest, or they're competitive premium-wise, apples to apples with other carriers. But also the flexibility that some of the riders and some of the options that Mutual Care offers, combine that with the ability to keep your clients out of the nursing home and at home. There is a serious emphasis from this product on keeping clients at home, comfortable, receiving the services that they need, and I'll show you why here shortly. All right, so let's just go top to bottom, left to right. So obviously you want to make sure that all the information that you're going to convey to your clients is accurate, right? So make sure you pick the state. I live in the state of Minnesota, so I'm just going to use my home state here. And then you have two different products, okay? So Secure is it's more of a base level product. It's the original version of the product, and it was updated in 2013 to the new custom solution, which we're going to focus on. Reason why we focus on the custom: it has more benefits, more robust, and is a little more flexible when compared to the Secure option, combined with the fact that most of our agents, they write custom at a very high level. Well over 90% of our agents will write a custom policy versus a Secure. All right, so partner status. This is either people that are in a marriage, or they're in a partnership, like a domestic union, that sort of thing. They're able to both get a policy, and if, let's say, both of them, whether, doesn't matter the gender, as long as they are both insured, you have the ability to receive a 15% discount off each policy. Now remember, these are not family plan type policies. They are individualized, but you can intertwine some of the benefits, and I'll get into that a little bit later. So 15% if they're partnered and they both have a policy. Partner one insured refers to someone's in a marriage or a partnership, but only one of them is going to be receiving a policy for whatever reason: health, wealth, don't want it, what have you. If only one person gets it, there's a 5% discount off of that policy. And then if someone is single, they're not in a partnership or a marriage, they have the ability to go as a single, but that does not trigger any sort of discount. As I mentioned before, the person in red represents a male and the person in blue represents a female, so it's important to distinguish that. Reason for that is women are significantly more expensive with regards to insuring for long-term care. And the reason for that is because typically women live longer, and women are responsible for a high majority of the claims that are paid out on a yearly basis. So from a practical standpoint, that's essentially how that works out. So let's move on to their age. Now, you can just type in or click on an age here if you would like. However, the best way to do it is to grab your client's date of birth and enter it here. It will automatically populate the age, okay? And the reason why I mention that is because let's take Mrs. Valued Client here, okay? She's 55 years old. In real life, she's 56, but her birthday was in the last 30 days. Mutual of Omaha offers a saved age benefit to where if someone has, it is within 30 days of a past birthday, you're able to lock in a you're able to lock in last year's rate if as long as that application is signed and dated within 30 days of a prior birthday. Hopefully that makes sense. So you're able to offer a little bit better benefit and value to your client while doing that. Okay. So class, what that refers to is the rate class, excuse me, that your client would be entitled to. Now, from a coaching standpoint, or if an agent were to ask me, what would you recommend? What would you quote for your clients? Straight from your underwriter's mouth at Mutual of Omaha, they recommend and always recommend Select is the only option. The reason for that is because the majority of people that apply are going to land in the Select category should they be approved. You can also get a preferred discount. It's a 15% discount should they meet that classification, and you can find that information inside of this underwriting guide, as I mentioned. There's a portion in the guide that refers to the criteria that's required to achieve preferred status. I joke around the office that you need to essentially run a marathon or run marathons and eat rabbit food all day. That's my tongue in cheek, but most people, in all seriousness, are going to land on Select. Now, class 1, class 2, these are for higher risk people who have a few extra health concerns that are of a concern to Mutual. They'll still underwrite them. However, they're going to increase their premiums to match the risk, obviously. Also, when it comes to Select, right, another reason why underwriters recommend going with Select over preferred is just you don't want to overpromise, right? If you promise somebody a preferred rate, they come back with a Select. Obviously, that's creating a less than ideal experience for your clients. So if you tell them Select and they end up in preferred, you look like a hero because you're able to offer them a premium that's cheaper. So takeaway, just recommend Select. All right, now the meat and potatoes of the policy are the monthly and the monthly benefits and the policy limits. Okay, so the maximum monthly benefit refers to the maximum amount of benefits that the insured would receive each month. This number will grow with the inflation rider and refers to home care and facility care, as well as the other benefits that are associated with the plan, such as respite care, alternative care, hospice care. It's a very comprehensive policy and benefit. Assisted living is in there, nursing home as well. Now, policy limit. Oftentimes agents will ask, can I get a $100 a day benefit for a 5-year quote? Well, what does the time matter if you really break it down, right? All this is take $100,000, which is the policy limit that I have in this example. We divide that by 3,000, and that's going to equal this 2.78 number, okay? So a lot of assumptions being made there. That's assuming that the maximum number of benefit or the maximum amount of benefits, the ceiling, were to be used every single month until the policy limit is exhausted, okay? That's not necessarily the case. Sometimes services are cheaper. Sometimes the need for care isn't as much as it would be in the future potentially, right? So all that the years are is just math, and we try to coach agents to get away from the whole time period idea and focus on a bucket of cash, right? Because that's what's really important. How much cash is it, and essentially how long is that going to last? So in this example, we're going to use a $100 a day, just a basic $3,000 monthly benefit, and we're going to put a $100,000 policy limit on each of these policies. Remember, they're individualized. And with that would essentially break down to 2.78 years. Okay, we try to stay away from the 3-year threshold because recent rate increases. Now, note, they're not enforced rate increases. They are only for new business. So we have not seen a enforced rate increase since this policy originated in 2013. And if you've ever sold long-term care before, you and I both know that that is a lifetime. These rates have stabilized. So for people with the objection, I want a policy that is going to guarantee my premium and it's never going up. Well, it's not the case with long-term care, but those concerns have been alleviated on a very high level because the industry knows more about claims. They have more, I think it's 70 times more claims data than they had 20 years ago, roughly. Don't quote me on that, but I know that that figure is pretty close to accurate. So essentially, the industry has enough information to price these plans where they need to be. And if they are going to be increased in the future, they'll be subtle, and they're not going to be these huge 100% increases that some of these old policies, these legacy blocks, have seen. Anyway, so the next part of the software is the elimination period. So as you know, once the benefits are triggered, there are typically with long-term care policies, there is an elimination period. And this refers to the amount of time that the insured is going to be out of pocket paying for their long-term care services, okay? Now, as you can see, there are lots of good options here, okay? Or lots of different options, I should say, which keeps this thing flexible. Part of the allure of mutual care custom solutions. Now, I'll be honest with you. The only real option is 90 days. I mean, if you want to, you can shorten it up to 60, 30, or 0, but you're going to see that the premiums increase significantly. And you can see the premium part of the quotes here. So I can change that to a 60, and you see that that raises the premium about $600 a year. 30 bumps it up significantly, and even a 0, you know, we're significantly higher than the original 90-day elimination quote. So same thing goes with 180 or 365. You're not saving a ton of money. That's saved about $90 by doubling the out-of-pocket time. And if we quadruple that to a full year, you saved yourself about, you know, 160, 150 bucks, right? At the end of the day, 90 days is the sweet spot. So there's two different types of benefits. I'll go over both of them. But with regards to reimbursement benefits, the 90-day elimination period is essentially the industry standard. And on day 91, after the insurance, obviously the long-term care insurance benefits are triggered, day 91, Mutual of Omaha will start paying out on those benefits based on the plan of care. Now, this is all encompassing. This elimination period refers to both home health care and facility benefits, okay? Now, with the emphasis on home health care, right, that's a strong benefit to this plan and Mutual of Omaha's product in general. People want to age at home, as I mentioned, and stay out of those facilities where there's so many issues. Well, you can help keep your clients at home by checking this home health care waiver, okay? It adds to the premium, of course, but what you're doing is you're making it so if it's important to your clients that they receive home care on day 1 when they need it, right, they can get that without having to go through that 90-day elimination period, okay? Now, that's specific to home health care. It would not apply to any facility care, but just so you know, it can add some serious value to your clients and give them peace of mind of knowing that they're not staring a facility stay in the face should they be healthy enough to stay at home. Now, let's talk about inflation, okay? So inflation's just like it sounds, right? Costs of services and care, they go up, just like a loaf of bread or a gallon of milk. As we're seeing right now, inflation's a little bit on the high side, so we're paying more, okay? So we wanna make sure that as the costs of these long-term care services increase over the years, we wanna make sure that the policy values and benefits also increase. So general rule of thumb, 3% inflation will double the values in about 25 years. And I'll show you that in a little bit here. But a $3,000 monthly benefit will turn into about $6K in 25 years. Same goes with the $100,000 lifetime bucket of cash. This will turn into roughly about 200K in that 25-year period. And just while we're on the topic, most people, when they go on claim, they need services at about age 80, right? So that puts Mr. and Mrs. Value client here in Minnesota about 24 and 25 years away from receiving care. So essentially, in this example, these benefits will double by the time they need it, statistically, of course. Now, so I put a 3% inflation on this quote, okay? Now, what about the term? How long do we want this policy, the benefits to grow by that 3% number? Well, like I said, at about age 80 is where people are going to need services. So I always try to work backwards. I always recommend to agents to, if we, we want to get this policy ideally to about their 80th birthday, roughly. Let it grow until then without cutting it short. That's ideal. So with that, we're going to do a lifetime benefit here rather than the shorter 20, 15, or 10. If your clients are a little bit older, you can make some of these 20, 15, or 10 years work. But just to keep things simple, we'll keep it at a lifetime. Now, you'll notice that when I clicked on the screen here, it started yelling at me in yellow, okay? That should tell you that you made a mistake that needs to be fixed before we can get this full premium, okay? So what happens is on the bottom here, you'll see this yellow option. It's gonna tell you what the problem is and what you need to do to fix it, okay? And what it is it's telling me I'm not qualified, or this person's not qualified for partnership based on their age. So, and I'll get into partnership a little bit later, but it just requires at least a minimum amount of inflation based on their age. So for this, we're going to do a lifetime inflation at 3%. All right. And there's some other buttons. You see the pick inflation, and you see the set target premium, pick max, pick, things like that. My teammate Lynn Voss is going to be going into that in a little greater detail next month, and I'll introduce that webinar towards the end of our presentation here. So I'm not going to go into that, but I'll go over the meat and potatoes of the benefits here so that everybody all understands that. Now, just going line by line, the monthly benefit adjustment options. In layman's terms, what that is these are buttons that you can use to lower the premium and keep the cost a little more favorable to your client. Now, there are ways of doing that, and then there are ways of not doing that, in my opinion, okay? So I'm trying to take my bias out of this as best I can, but I do have some opinions on some of this stuff, and they're educated ones, so I'll tell you why I feel that way. With regards to assisted living facility reduction, this gives you the ability to lower this $3,000 monthly benefit, or whatever it grows to. That's the ceiling for assisted living at 100%. That's how it's built in, okay? Premiums are showing that. Now, if I want to lower that, okay, I'm going to take that $3,000 benefit or whatever it grows to, and I'm going to say my ceiling for assisted living care is only 3/4 of that, okay? So I just lowered the premium roughly $120 while limiting my client only being able to use 3/4 of this benefit, okay? Same goes with the 50%. I just saved roughly $300 on the premium by lowering my client's ceiling to 50%. You can tell where I'm going here. I don't recommend touching this number unless the monthly benefit numbers are significantly higher, right? $10,000 is the maximum that you can start on the monthly benefit. The closer to $10,000 that you start this policy at, the more I could see recommending lowering this. But I just don't like lowering your client's ceiling on some of these benefits just to save a few dollars here or there. There are better ways of doing that. Now, let's move over to home health care. This one's a never touch, in my opinion. I don't ever recommend touching this because the cash indemnity that's built into this product, I'll get to that in a second, is handicapped to 3/4 or to 50%, along with the home health care benefit being lowered to 75 or 50% for your clients. I just tell agents, keep it simple. You're not saving that much money by lowering it. Keep your client dangerous with the most amount of benefits available to them. Just leave these two at 100%. Keep it simple, okay? Generally speaking. Now let's talk benefits. Okay, so come claim time, right? The way that these benefits are triggered, as most of us know, is your client cannot take care of themselves with regards to the daily activities of living, such as eating, bathing, dressing, toileting, etc. Okay, so Mrs. Valued Client notices that Mr. Valued Client is not doing very well. She calls the doctor. Doctor then signs off, says yes. For at least 90 days, Mr. Valued Client is going to need long-term care services with regards to those daily activities. He cannot do them himself and requires significant assistance to do that. Okay, so benefits have been triggered. Mutual is now going to ask Mrs. Client or Mr. Client, whoever's on the phone, how would they like to receive their benefits? And there's two ways of doing that, okay? What we spoke about up here with the monthly benefit and the elimination period. What I'm referring to is the reimbursement benefits. That is the full number of this 3,000 or whatever it grows to, 6,000 in 25 years roughly. They have full access to that. Okay, there's no cash. It is just basically reimbursements. They submit receipts for services that were rendered, or they pay for those services, and then mutual will then reimburse them. Okay, hence the name reimbursement. Okay, but the caveat here is this elimination period of 90 days needs to be satisfied by that, okay, or by that time. So when I say day 91, that means that they've satisfied that 90-day elimination period. It's a calendar day elimination period, which is really nice. All you need to do is have your client get one service performed and submit that to mutual. 91 days later, they get access to these benefits. Okay, that's reimbursement. Now, in contrast to that, we have the built-in cash indemnity benefit. As you can see, this 25% number, that is the maximum that they can receive at a maximum of $2,000. So as you can see here, we have the $3,000 monthly benefit. We're going to multiply that by 25% or 0.25. As long as this number shows 100, okay, they're going to be able to receive each a $750 cash benefit. They can't do both reimbursement and cash at the same time. So when it comes time to do claim and receive these benefits, they have to decide one or the other. Now, the nice thing about the cash benefit is it does not, I repeat, it does not require your client to have to satisfy that elimination period. They're able to get this cash on day one, okay? Now, real life application of the cash benefit, say for example, Mr. Valued client, his needs are not super severe at time of claim. He just needs some help with his normal daily activities, and his wife, Mrs. Valued client, can provide those, right? But if she does, she's going to be taking away from other aspects of her life, right? So what you can do with that cash, ideally, is pay loved ones to come in and provide those services for Mr. Valued client that he needs, okay? Now, obviously, at time of claim, you need to figure out, what are the level of services, how much are they going to cost in your individual state, and make the appropriate, recommendations. So they could go either way, just totally depends on everybody's situation. But the fact that the cash is built in to this product and this policy makes it very, very appealing, right? A high majority of people who receive care don't necessarily need, in-home medical care. Sometimes or majority of the time, they just need help with getting around day to day, how they eat, how they dress, things like that. So that's where the cash comes in. And remember, the cash does not require an elimination period. Now, let's say they start with the cash and care progresses. They need more care. They need more money to pay for these services. Well, Mrs. Valued client would, in this example, would call mutual and say, hey, my husband, Mr. Valued client, he needs some more care. We want to switch him over to the full reimbursement benefits. At that point, they will make the adjustment, and then the 90-day elimination period will need to be satisfied at that point. So important to remember that. Okay, now let's slide over and talk about some partner benefit options here. All right, so these 4 options help take care of the insured spouse or partner. The first 3 options, shared care, survivorship, and joint waiver of premium, they require that both have mutual long-term care policies with exact matching benefits. It's very important to remember that, okay? Now, the security rider, and I'll get into that shortly, is for people in a partnership or a marriage, and only one person has a Mutual of Omaha long-term care policy. Shared care is a rider that allows the client to access benefits under the partner's identical policy if they use all of their own benefits and still need long-term care services. So they can eat into or piggyback onto their client or their partner's policy there, and they can use all but 1 year of their partner's benefits. They have to leave at least a year, because that wouldn't be fair to the other partner, right? Now, survivorship. This is a rider that waives the premium payments for a surviving partner if one partner unfortunately passes away after both policies have been in force for 10 years. So this is a good way of taking care of their partner. You know, at the meeting, you ask them, or they bring it up to you, it's important that they take care of their spouse. Well, the survivorship rider, that makes sure that that policy is paid up in full upon the unfortunate passing of their partner. So the policy will continue to grow with the inflation that they have until the day that they need, you know, claim services. So it's just a good way of taking care of your partner or spouse. Joint waiver of premium is another way that they can accomplish that goal. This rider waives premium payments for partners that are not on claim while the partner is claiming benefits. So Mr. Valued Client, for example, he's on claim, he's receiving services. Mrs. Valued Client, if they both have this rider attached, she's going to be able to skip her premium payments while he is on claim, okay? Now, don't mean to be morbid here, but most people who go on claim typically don't come off of it. So essentially, you know, when that person were to pass away, unfortunately, the surviving partner, they would go back to making their premium payments the following month. So, but in that meantime, during that tough period of time, cash is probably tied up in taking care of the spouse or the partner. This is a good way of giving them some peace of mind that that time will be a little easier financially for them. Now, security. This is a rider that provides an additional 60% of the monthly reimbursement benefit that can be used to pay for care or living expenses for your uninsured partner while they receive long-term care services. Okay, so one person, this is a one insured benefit. The one partner, let's say Mr. Valued Client has the policy, Mrs. Valued Client, she passed on it. She doesn't have it. She's not healthy enough to pass underwriting. So he has a benefit. He can then click the security rider, and that will add a 60% premium load to the premium, okay? And what that will buy is an additional pool that will give an additional 60% of this monthly benefit or whatever it grows to, and that can be used to help you know, pay for care or living expenses for the uninsured partner while the insured receives long-term care services. So it's not a really popular benefit, but it does have some value for some clients. So wanted to mention that. All right, now we'll go down to this final line here. Under other optional benefits, we have the non-forfeiture shortened benefit period rider. I'll be honest with you, I tell agents just leave this thing alone. What non-forfeiture is basically there is a clause that's built into every long-term care policy, including Mutual of Omaha's, that says if based on a rate increase, which again I mentioned is very unlikely that it's going to be significant, but in the future it's written into the legalese and in these contracts. If in the future there is a significant enough rate increase percentage-wise based on someone's age, they have the ability to walk away from the policy and keep paid up benefits. So not to throw all their money away that they have already paid in, okay? So that's already built in. So if you were to add this rider, all that does is give your clients an out at any time that they can just walk away from the policy and they are able to keep their paid up benefits. But the key there for the rider is it just gives them an out for any reason whatsoever. I don't like the rider. It's already half built into the policy. I tell agents just to leave it alone. So now when it comes to 200% home health care, this is a really nice benefit because although it does not add any money to the policy, it does increase the ceiling if somebody were to receive home health care services. Okay, we could take this $3,000 or whatever it grows to, and we can double that. Okay, so if home health care services are a little more than expected, you know, if you have that rider at the beginning of the policy, you have the higher ceiling for home health care. Again, you keep hearing the words home health care. It really sets this product and this policy apart from its competitors in the marketplace because we want to keep people at home. We want to keep people, you know, out of those statistics that we talked about. We don't want them to feel like they're going to pass away in a nursing home or be scared about going in and catching COVID. So anyway, partnership. We could literally talk for an hour about partnership, but I'll just kind of go over it briefly. Partnership is a joint federal state program initiative to promote the purchase of private long-term care insurance. It allows the insured to protect non-income assets up to the policy limit in case of a Medicaid spend down once the policy has been exhausted. So they have to go through their benefits on their policy. Should they still need benefits and they don't have a shared care rider from their spouse to piggyback on, essentially they would go into a Medicaid spend down situation, and they would be able to use the policy limit up to the policy limit for dollar non-income asset protection. So let's say a lake place or some sort of property that, you know, up to that dollar amount would be able to be protected in that Medicaid spend down situation there. Now, people often ask, you know, what happens if I pass away before I can use this policy? That's a legit objection, or a legit question, I should say. Opportunity to educate. So a good way to overcome that objection is to offer a return of premium rider should your client be under age 65. Now, not everybody who applies or brings it up or you find a fit for long-term care is going to be under the age 65. But the sweet spot, you know, is prior to age 60. You're able to lower the premiums for your clients, able to get them access to some other riders like the return of premium riders, and it gives the policy time to grow. Okay, so we'll talk specifically about this return of premium and these riders. So you have the before age 65 less claims rider, and you can see that you can hover your mouse over some of these options. It'll give you some more information. So essentially the way that this one works is if it took the before age 65 rider, if the insured were to pass away before age 65, all of the premiums would be returned to their beneficiaries minus any claims that had been paid out prior. Okay. There is the full less claims benefit, which there is no age limit on that. You click the less claims benefit and you're able to essentially get guaranteed every dollar back to the beneficiaries that's ever paid into this policy, subtracting any claims that were paid out. Now you'll notice the premium though, it adds a significant amount to the premium, okay? So it's important to know that, but you know, from a return on investment standpoint, that might just be worth it for your client, depending on what they can afford. But I skipped over the 3 times MMB for a reason, because this is the sweet spot. So the way this works is for not a super high premium load, it's got some decent value to it. You're able to essentially take the original, not what it grows to, but the initial monthly limit, monthly benefit, or monthly maximum benefit, or MMB as they call it. You're able to take that number and you're able to triple it, okay, upon death. Keep in mind, these are death benefits. So if Mr. Valued Client were to pass away, then he's able to pass on 3 times this number. So let's call it $9,000 minus any claims that were paid out to him, okay? So it can act as a mini life insurance or final expense policy and help pay for things like burial costs, funeral, you know, cremation services, pay off some debts that were left behind, leave a little bit of money to the loved ones. All those goals could be accomplished on some level by having the 3 times the monthly benefit. So I like that, and I recommend that to a lot of my agents. So, you know, for people who ask, you know, like I said, if they have, you know, what happens if, you know, I pass away or I don't get to use this? Well, hey, you can at least offset that objection somewhat, okay? You can always partner with a final expense policy or some sort of life policy that would pay out a you know, substantial death benefit to help cover some of these premiums. But that's a story for another day, so I'll leave that alone. And then under mode here, this is the premium or how they would like to pay their premium. So they can go monthly, they can go quarterly, they can go semi-annually, which is twice a year, or they can go the full annual premium. Monthly is just a straight up number. Quarterly, semi, and annually receive a little bit of a discount. So if they're able to pay in full, they're able to save a few bucks. You know, if they wanted to go a shorter time period, they could do that as well. Now, I'm going to go over to the discounts and talk about those briefly here. All right, so there's 3 ways that you can receive discounts on this policy outside of the partner benefits or the class, right? The preferred benefits, right? So, or the preferred rate class, I should say. Now, the association. So if we have an approved association from Mutual of Omaha, basically anybody that works at that association that signed up for long-term care would receive a 5% discount, okay? If you are a writer and you want to write a policy on yourself and your spouse, for example, one of my good agents recently just did this, and they were able to receive not only if they receive a 5% discount on top of the partner benefits that they received. So both partners received 15% off each policy plus 5% for the producer discount, okay? As well as the common employer. So I'll read over this. There's 5% off discount if 5 or more applicants apply and they share a common employer. They must be submitted together. And once they are submitted, others that are a part of this same employer, let's say they come later and they want to apply, they can also receive a 5% discount, piggybacking off that same original setup that was done. All right, so that is the majority of the product and the software. I know I'm running long on time, but I really don't want to cut this short, and I see everybody's still here. So thank you for your patience. I appreciate it. It'll be worth your time, I promise. Let's talk about some quotes. All right, so I ran 3 quotes here, and I'll go into them and kind of explain my thoughts and my thought process here. All right, so again, we have a Minnesota couple, Mr. and Mrs. Value client. She is 55 with the birthday in the past 30 days, so we're able to save her age. And Mr. Value client is 56 years old, okay? So I have 3 different quotes. I'll go over each individually. So we have a $3,000 a month base benefit or monthly maximum benefit, and then we have a $100,000 lifetime bucket of cash or policy limit, as we call it, okay? And then obviously we have the 3% inflation that's gonna grow for the life of the policy until they go on claim, and that's paired with a 90-day elimination period. To keep things simple on these quotes and apples to apples, I didn't add any riders other than inflation. Those can be added separately, but I just wanted to keep things a little simple for illustrations purposes. All right, I'm going to go into this in a bit here, okay? But the preview option is going to show, essentially a quick overview of the illustration, and I'm going to use that in a second to compare these 3 breakdowns, okay? So when you go to preview, make sure you select all, and then you can go to OK. It's going to build a report that has the full illustration, all the good information on there. I'll go back into that here in a bit shortly, go into more detail. Now, you'll notice the premium, okay? If you get a premium, that means there's no mistakes that were made, nothing that needs correcting. We're good to go there. Let's take a look at the second quote. Okay, we're in yellow because I made a mistake. I need to fix that. What is that? The plan qualifies for partnership, doesn't add any additional premium. This intuitive software will not allow me to get a premium unless I choose the partnership if it applies. So we're going to choose that. Okay, this quote is a $150 per day benefit or totaling $4,500 per month, and has a $170,000 policy limit to begin with, okay? Now, it is a 3% growth on compound inflation, no more simple. Compound is better for everybody. So 3% inflation compounded for life of the policy with no extra riders, we're at $5,168.33, okay? Notice the difference in the premiums here, okay? So we got a 50% higher benefit roughly, and we're adding about 50% more to the premium. Now, I have a third quote. It's a little bit different. The reason why I did it differently is because when we had these non-enforced rate increases, remember, they did not hit anybody who actually had a policy, only new business, people who signed up after these increases were affected. So when Mutual did their rate refresh, as they call it, in 2021, some things that were affected were particularly 3% inflation. So when I say affected, that means that they increased the premiums higher than they used to on that particular inflation number. So to counteract that and to keep things, somewhat similar, We went to, instead of a long and skinny approach, as we call this, lower benefits, longer time period, we went to a short and fat approach. And what I'm referring to there is we just went from a $4,500 monthly benefit to $8,000. We just went from a $170,000 bucket of cash to a $275,000 bucket of cash, significantly higher, okay? What's the difference? We dropped the inflation from 3% down to 1%, okay? It's gonna grow significantly slower. Everything else is equal. Same thing as, the only difference is the inflation number. Now, let's go back to number 2. See this number? Hopefully you can see that there. Just over, or just under 5,200 per year between the two of them. I then created a quote for the short and fat approach, much higher benefits here, giving them much more cash available to them, and we put it at the 1%. Look at that premium. We are within $7, not even, we're within $6 of the premium, okay? Now, what does that mean? Okay, so I like to refer to this as the tortoise and the hare, okay? So you have these two racing. Obviously, the tortoise is going to get the head start, and they're able to start with their benefits much higher, okay? On day one, they have 8,000 and it's growing at 1%. They have $275,000 bucket of cash, it's growing at 1%. Essentially, they're starting the race with a head start. The policy benefits don't need to grow as fast or as long because they already have a very healthy, robust policy here, okay? So, but you see there that we're able to keep the premiums in line with each other there. So just a way that we're able to keep the premiums cheaper and more affordable for the clients while giving them a whole bunch of bang for their buck. Now, let's take a peek at some of these, what they actually look like on the illustration. So I'm gonna go under PDF. PDF, like I said, is gonna give you the same options as preview, but it's gonna let you save it, okay? So I'm gonna select all these options so we can look at all of the different information on the page, and then I'll pull up a full illustration here, okay? You know what, scratch that. Let's just go back to preview. I'll pull this whole thing up so we can see it. We can save it later. All right, so you can zoom in. I like to keep 2 pages together here so we can all see together. All right, so page 1, you'll notice that it has my name or the agent's name, all kinds of good jargon and looks super official for your clients. Page 2 is going to have most of the pertinent information, their name, their age, all the different benefits that they have here, okay? The inflation, if it's partnership, I won't go into everything here, but it has the discounts and all that good stuff, as well as the premiums, okay? It'll break down a monthly premium, it'll break down a yearly, and so on, okay? But I wanna focus on page 5, okay? You'll see that it's got some different information here. It gives you alternate coverage options, things like that. But I'm gonna focus on page 5, okay? Because this is where the inflation is gonna grow to, all right? So, matter of fact, let me open up one of the smaller ones. Let's do preview. Let's do the $3,000 premium here. Or you know what? Sorry, I'm arguing with myself. Don't laugh at me. All right, so we're gonna do the $4,500 quote. We're gonna pull up the inflation growth on page 5. Make that nice and big for everybody to see. Let's go down to page 5. All right, so page 5 here is gonna talk about the inflation protection comparison, okay? So the monthly maximum benefit, which started at $4,500 on day 1, it doesn't show 25 years, but you can do the math between 20 and 30. So essentially, in 25 years, this $4,500 original number, that's gonna grow to about $6,700 per month. And this $170,000 bucket of cash, that's going to grow to about that's gonna grow to about $350,000, $360,000 for a bucket, right around that 25-year range, okay? So, it's gonna double, like I said, in 25 years, okay? So keep in mind, and keep an eye on these numbers. Now, let's go ahead and pull up the short and fat quote. So for the same premium, within $6 of each other, we have a completely different policy. Yes, the inflation is lower. It is going to grow slower. But what does it matter if the policy, benefits are already very healthy? Okay, so that's kind of my point. This $8,000 number, okay, at a 1% inflation rate in 25 years is going to be roughly $10,200 per month. Okay, you notice that that's significantly higher, about $10,000 higher than what the previous one I just mentioned. Okay. Now on the short and fat quote at $275,000 bucket in 25 years, that number is going to be about $350,000. Okay, that's a little bit less than the $4,500 per month quote, but we're in the same ballpark. Okay, and the reason why I would give this $8,000 number or this $8,000 illustration the benefit of the doubt here is because of the cash. Okay, we're not talking about a smaller number on the cash. We're talking about a maximum of $2,000 that's available on day one should they need it. And when it grows, it's going to grow to roughly $2,600 in 25 years there. So it keeps them a little more dangerous, so to speak. It gives them more access to funds should they need it, right? The cash, like I said, if majority of people are just receiving custodial benefits at home, having that cash, a higher number of cash available to them, that's very, very attractive. So that essentially is our presentation for the day. Let me switch over here. Give me one quick second. All right. So like I mentioned earlier, my teammate Lynn Voss, she is our marketing MVP, or one of them, I should say. She is just a rock star around here and does everything for us. So among the many things that she does, she's also going to be putting on a webinar, a little higher detail or higher level presentation on this product and the software on Thursday, March 10th at 2 p.m. our time Central, 3 p.m. Eastern time. And we'd love for you to join us that day as well. Feel free to come up with any questions that you have, and we'd be more than happy to answer those for you. But like I said, this is our presentation for the day. I hope that you all enjoyed it and learned some good information to help your clients. Again, I apologize that I went a little long. I knew that was going to happen because I didn't want to skip any of that good information. And again, my name is Cris Paulson. And if you're not appointed with us for mutual long-term care or any of our other products and carriers, please go to goldencareagent.com and click contracting, or give us a call today at 1-800-842-7799. And we're always more than happy to help. Thank you again for your time today. I really appreciate it. Hope you enjoyed it. And I also hope that you all have a great week. Bye for now.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.